property is a religion in Australia.
People are moving away from the major parties. Which political party is going to go to the election saying house prices nationally dropped?
This is the biggest attack on wealth creation that Australia's seen for years.
CBA, the biggest bank in the country who does the most lending, was down 10% just by what came out from the budget.
Australian Battle's the one trying to create wealth for themselves.
People are hurting. It's not people that have 20 properties that are going to suffer. It's the people that are trying to get into the market to build something.
Hey Andrew, thanks for joining us once again for our podcast. I'm glad we've got a tax advisor out here today because I want to chat about the budget. Man, the budget came in and it made waves through Australia, I think. So, what's your thoughts? What's your initial thoughts on that?
Oh, look, I think it was a bit rough. For sure, the government, I think, went harder than what people were expecting. Mm-hmm. We knew that property investors were going to get targeted, or the media was leaking it as well.
Yeah,
the property investors have made a lot of money over the last few years, and they definitely had a target on their back.
Mm-hmm.
I think the one that caught people off guard was the amendment to trusts, which is a big one.
That is a huge one. And now I have to ask a question about the amendment for trusts. And for those that don't know, it's 30% minimum tax on the profit of the trust before distribution, right?
Yes.
So with that, is that grandfathered as well? Like, is that going to apply from new trusts, or is it existing trusts? Like, how is that going to come into effect? Is there any data on that or information on that?
Well, the rules at the moment, and the thing is, it hasn't gone through Parliament yet to get stamped. And this change is supposed to start on the 1st of July 2028. So I think it's going to get watered down, to be honest, just because the next election is going to be in 2028, in the March of 2028, we could say. So I think this is going to get very watered down. It's going to be a big election issue as well, because trusts impact a lot of people, including banks. And I'm sure there's a lot of wealth in trust funds at the moment. And it's one of those things that's like mucking around with the super system. You know, people have planned for years and years and years to use these structures. And now all of a sudden, the government's come in and it's changed it and basically gone to it with a sledgehammer.
Well, that's what I'm thinking with, that's what I was asking if it was grandfather, because you're right. A lot of people have set up these discretionary trust structures for the purpose of, wealth distribution or income distribution. And now that might not be a suitable option for them. And so there's, it would create a lot of issues. I think I mentioned to you as well, is that it goes against the idea of a trust in my head. So, trust is, you've got the trustee who's the custodian of assets, whether it's money or property or whatever. They're the custodian on behalf of the beneficiaries. And so what this government's proposing is that we're taxing the custodian at the custodian level and not at the beneficiary level, who really are the recipients of that income. And I think, and I understand it'll work similar to like dividends, right? From a company where they sort of get paid out and there's credits and stuff like that, from what I understand.
At the moment, and this is where the sticking point is, like, you've probably heard of concept of bucket companies or investment companies. Yeah. These are all going to get impacted by these trust distributions. So, I think, there's a long way to go with the trust stuff. I think it's going to definitely be a hot topic over the next few months and few years. But I think they were targeting property investors because they were saying, well, all these investors have bought properties within trusts, they've made money, and then they distribute those profits to lower tax beneficiaries. Yeah. Now we're just going to get them all, So I think it was a blanket approach to try and hit the property sector, which they've done. I don't know if you saw the stock market yesterday, CBA, the biggest bank in the country who does the most lending, was down 10% alone, just by what came out from the budget. So, the market is thinking, well, lending is going to get impacted. Investors are going to be buying less. There's going to be less money going out the door. So for that reason, CBA shares dropped.
Well, interestingly, with the negative gearing changes, when you said lending is going to be impacted, we actually, as mortgage brokers, we factor in negative gearing into servicing. So we can sort of add back, certain amounts of figures depending on their income to assist with the servicing of a loan. Now, at the moment, there's been no communications, at least at the time of making this podcast, there's been no communication from the bank of how that's going to be adjusted for new properties. I think at the moment it's sort of everything sort of stayed, and I think probably the bank's risk and credit team are now trying to figure out, do we turn off negative gearing in our calculators? But that's going to make it a lot harder. That can be a huge impact to borrowing power for property investors who are buying a new property after this week. Yeah.
Well, it's going to impact those people that are trying to get into the market, especially if you already have one property that you live in, you're looking to get the second one as an investment property. A lot of people rely on that negative gearing for the tax refund at the end of the year, and it's like, well, I'm going to spend all this money on this property throughout the year, and I get a tax benefit at the end of the year. Now, like you said, if we're not going to get a refund because the property is negatively geared, but we can't get the refund for it, it's going to impact cash flow, meaning you're going to be able to borrow less, meaning you're going to have less cash to spend. So it makes that investment less attractive, essentially.
Yeah, and you've seen those cash flow forecasts before, where you got your 5-year cash flow forecast, and then you work out what your weekly expense is, and it might be $400 a week pre-tax, but then after tax it's $200 a week, and that's what a lot of people, when they are planning, their investment portfolio, their investment journey, is that they look at that bottom number, their after-tax expenses, because they know that at the end of the tax year, it'll all sort of come back, and it'll roughly be, let's say, $200 a week, for that individual. But now it's $400 a week. It's going to be $200 a week more to hold that investment property. Now, will that make investing, not attractive anymore? And I'd say for some it may, but if you've got the cash flow for the $400 a week for the pre-tax, and with growth of property over, historically, I think it's still a good, it's still a good avenue and a good, safe bricks and mortar investment for a lot of people who are wanting to invest. But then the question is, what impact will this have on the property market and growth? Will we expect the same growth as we have historically with these changes?
Well, we can see what Labor's trying to do. They're trying to get more investment in the newer market, which makes sense. That's why they're going to give the negative gearing benefits to new builds, because new builds add to GDP. When people buy and sell current stock, it doesn't really add GDP apart from the standard, the real estate agent gets paid, the mortgage broker, and all the rest of it. But the actual physical building is not built every time. So it doesn't give that much more of a GDP boost, essentially. So they're doing the right thing. I think they're targeting the right area. But the thing is, now what you're going to do is you're going to get a cohort of investors that had the ability to invest in anything before. Now all of a sudden get pushed to a certain segment. Okay, the established builds may have less competition, less investors. The first-time buyers are possibly able to get in. But what's going to happen is the new builds are going to go up in price eventually, because all the investors are going there.
And they already are because of fuel crisis. So.
Yeah. So once that happens, you're going to have like the market going in a totally separate direction in a V shape. And what it's going to do, actually, it's going to force the lower price properties to move in line with the expensive properties anyway, because that's essentially what's going to happen. If a house now, the new bills were 1.2, they're going to jump to 1.5, and existing property is 800,000. That's naturally going to go up in price as well as it follows the market.
Yeah, I think that's funny when the government, I swear the issue I think we have at the end of the day is that property is a religion in Australia, right? It's like our most followed religion. and so it doesn't matter what the government does, people are still looking for opportunities to property invest. And that will always drive, like you said, if we're shifting focus to new, that's what the investors are going to do, because people love property. You also have a whole market of mortgage brokers and advisors and buyers agents and real estate agents and things like this. Huge employer, I would say, in Australia is the property industry. If I even pull in the banks in that as well, because a lot of their lending is property investment lending, right? So there's so many employees in that industry, so they will find a way to push those prices up regardless. And I see the government's trying to do a lot of changes, but But I think at the end of the day, you're just going to constantly see a desire for Australians to buy property. And I actually have a few clients and I know a few people where the sentiment is actually they're sort of sitting on the sideline. They're watching and waiting, for something to happen so they can come in. And when that happens, that obviously lifts the market as well. So, yeah, it'll be interesting to see.
Well, I think there's going to be a little period of uncertainty, like what's going to happen next. With one of the capital gains tax deduction or reducing it, it's going to start 1st of July next year, apparently at this stage. So what's going to happen is you've got baby boomers that have all these properties, or not just baby boomers, people in general that have these properties now have a 14-month window to sell to basically apply the old CGT rules. So the way you got to look at it as well is like, if I hold on to that property for more than 14 months, essentially my tax on that is going to jump. So what would you do? You most likely would sell it. And I think that's what the government's trying to get people to do, is to sell properties to increase housing supply stock. And at the same time, trying to increase investment by getting people to buy new properties. So it all makes sense in theory, but at the end of the day, it all comes down to what the market thinks. And I think it's going to take a bit of time for people to get through the rules. The rules haven't been cemented yet. Like the trust thing, I think things are going to change over the next few months or few years. So it's going to cause people to just sit on the sidelines, to have a wait and see type of approach.
I don't think the trust. I don't like to think that the trust will hold. I think it doesn't make sense.
I don't think so either.
It doesn't make sense, and like I understand what they're doing, but it doesn't really. It doesn't make sense with the nature of a trust to have sort of that 30% minimum tax rate. Look, it is very interesting. So we got the capital gains tax discount, which is now, I think we had a podcast about this, and I was even talking about the 80s, or where they had the indexing, and I didn't actually expect that they would actually introduce that again. And again, the question is, does it make sense? I think the answer to that is yes. I think you could probably make sense of all these policy changes, especially capital gains, negative gearing, and the trust changes. But it's what will that mean is the real question. So I can understand the indexing of capital gains. It makes sense. Is that what's best sort of ongoing for property investors? Because property investors do create sort of a market where, rent can be, subsidized, housing can be sort of subsidized for people as well. I think there's this almost like this old school propaganda caricature of like the investor who's like got his like thumb on like the normal Australian battler, and we're making it hard. But I saw an article after the budget came out that said this is the biggest attack on wealth creation that Australia's seen for years. And I tend to agree with that, is because the Australian battler isn't actually not always the one paying the rent. The Australian battler is the one trying to create wealth for themselves. And that's through investing, and that's through buying property. I think that it's going to do a lot of harm, more harm than good.
I think as well, it's going to also push people to One Nation, because what's happening now, and I think, and we saw it last week with the Farah election, One Nation got up, and what's happening, like you said, it's not people that have 20 properties that are going to suffer. It's the people that are trying to get into the market to build something, to build their retirement. So, and when you tinker with these rules, you're going to impact wealth creation. And Albo specifically said, we're not touching CGT or negative gearing. And he said that many times, and there's so many memes about this, and it's been a direct attack. It's like, we are not going to touch it, but we're going to touch it because we have to touch it now. So it's like, what are you doing? So I think that causes a lot of distrust within the government. A lot of people are going, well, I'm not trusting the Libs, I'm not trusting Labor, and they're going to the fringes. Whether they go to the Greens on the left or they go to the right, One Nation, there looks like people are moving away from the major parties because you can't believe either of them.
It will be a fascinating election next year, because Albo's there's been a few hiccups in his during his term, I think, and it'll be interesting to see sort of what that narrative is at election time when it comes to sort of, okay, what's this government done and what's the new government going to promise. It's no new thing that politicians lie. I think that's
Yeah.
that's something that's been age old, but especially when he was very, very clear that he wouldn't make these changes, and he has. It's going to be really damning for him. And you're right. I think there's already, even before this budget, there was already a massive shift to One Nation, and a shift away from the major parties. So this will be an interesting election.
Well, all of these changes are to get more first home buyers into the market. The issue is there's first home buyers that want to get into the market. The issue is price. People cannot afford to get into the market. So technically, what you need to do is keep a lid on prices or make them go down. Which political party is going to go to the election saying house prices nationally dropped? No one's going to do that. It's going to be a suicide. So this is, it's like, I understand you have to help the first home buyers get into the market, get them a nice house, do all of that. But there is firstly no stock. Second of all, the stock that's there is so expensive that they cannot afford to get into the market unless they live 2 hours away from work or they go regional. So you've got all these other factors that are at play, and you're tinkering to say, hey, we're trying to help first home buyers while slugging everyone on negative gearing and capital gains tax changes. I think it's gonna erode the voter base.
Yeah, no, absolutely. I think, like I said though, like these changes to try and always, aimed at getting people in the market, first-home buyers in the market, have always resulted in increase to property prices. This is probably the first time, like for instance, the first-home guarantee. That just threw up everything. People, even during COVID, I mean, I know that wasn't necessarily for first-home buyers, but people drawing out their super all of a sudden have a deposit after, after COVID-19 with those incentives. We've extended the income cap, but they've extended the income cap, or got rid of the income cap for these guarantees. You can get them with a 5%, 2%. All of these are just driving property increases, right? Now, the funny thing is, though, is that it's not always driven. These changes don't always drive first-home buyer. It does that as well, but also drives investors, because investors love to invest in owner-occupied areas where people are buying owner-occupied properties. And so it's just created this sort of frenzy. And I would say that this is probably the first time where the government has introduced something where I'm like, oh, damn, okay, well, this might actually do something. This might actually, like you said, create a bit of uncertainty in the market. And we might see a little bit. I don't know what we'll see. Whether it's I hate to sort of predict because I'm always wrong. But will we see a bit of uncertainty, a bit of correction? But then investors will find a way, and first home buyers will find a way to get in the market too. The other thing too is I think a lot of, I always say this too, like a lot of my clients, and maybe I've got a limited view, but a lot of my clients who are first home buyers do turn their first home into an investment at some point in the future anyway. So it's sort of like, we're getting roof over their heads, but most people, even first home buyers, often will see their property as an asset for retirement or an asset for investment in the future.
Well, look, it also depends what happens overseas as well. Like we have fuel prices, which are going nuts again, even though apparently it's all sorted. Which is not, it's sort of blowing up. You see petrol, I saw today at $2.20 for unleaded.
What is the latest on that? I would follow that religiously, like weekly. And then because of all the budget and all this type of stuff, I haven't looked for the last week. I haven't even looked at what's happening with the fuel crisis and the Strait of Hormuz and stuff like that. Like what's the latest? Do you know the latest?
Well, petrol's back at $2.20 here. That's including the fuel excise reduction that lasts until the 30th of June. So prices are above $100 a barrel still. So it's still not sorted. And you've got Trump meeting with President Xi today for geopolitically to see if they can sort something out there. But yeah, this is an issue that's going to continue to go on probably for the next few months at least. It's not getting solved. Yeah. So
on top of that, we've got interest rate increases. May's a huge month, isn't it? May 2026. Remember this month. It's a huge month for the economy. So
well, people are hurting. Like rates have gone up 3 times already. Especially if you've got a big mortgage, you're going to be really feeling it. And it looks like it's not going to get any better. There's at least another 1 or 2 rate rises to come. And I know you and I were speaking last year. Everyone's saying it's getting cut. And we were probably one of the only few saying, hey, It's looking,
Not sure.
I'm not sure. It's looking like it's going to go the other way. And yeah, this fuel crisis has just further accelerated that increase. So, Chalmers is blaming the war. Rates were going up before the war. Inflation was already on its way.
Up before the war.
Of
Inflation's
course,
crazy. We're the only aren't we the only Western nation that's still got sky high inflation, and we're the only one that's lifted rates in the last last sort of decision making period. It's just it's what's happening, and people point the fingers at a few different things. It's probably government overspending. I think that's probably one of the main reasons for inflation. So it is one of the things from the budget, by the way, speaking of government overspending, I'd see a bit of, especially in social welfare programs, a bit of strictness that they've sort of implemented, especially with the
NDIS was the main one.
program, which is good, because I think the NDIS program is a good program, but it definitely needs maybe a bit of a overlook to make sure it's operating properly. But yeah, look, fascinating month. It's interesting. I'm super interested to see what's going to sort of happen. I don't think this is going to curb investors. Investors are always going to invest. Australians love property, so we'll find a way. It'll be interesting to see from a lending perspective these investments. But for those people who were already, investing in sort of trust structures, maybe not discretionary trust, we'll see, but trust structures in general, they're probably safe from some of these changes, which is good. And it is grandfathered. So if you've got a property at the moment, right, that's my understanding, is if you've got a property already, then the negative gearing will still apply.
Yes. Yeah. So so at the moment, the negative gearing applies if you already have it.
Yeah.
If you buy something post the budget night, there's no negative gearing available unless it's a new property. So, but again, these are still going through the laws. I don't know if it's going to get passed or not. But it will also impact, just because you said that, it will also impact the sale. Because now all of a sudden, if you're buying a property and you can negatively gear that property, for example, a new one, and you get all the benefits, the next person that buys that property won't get that benefit.
Won't get that benefit unless they're an owner occupier.
And that's a second-hand property. So all of a sudden now, even though the price may go up, it's going to become more expensive for that investor to buy the same property. So realistically, you would probably just hold on,
just hold on to it and see what happens. It's fascinating. Well, look, interesting budget. We'll see what happens. Do you think there's going to be a rate rise next decision?
I think so. I think it has to happen. If petrol stays where it is,
there'll be blood on the streets. There'll be blood on the streets, though.
I think there already is. I think a lot of people are hurting.
Heaps of people are hurting. Yeah, and like I said, I always find that there's sort of this overarching image of property investors, but a lot of my clients are sort of mum and dad investors, new couple just wanting to sort of build a bit of wealth. Some rent investors as well, they couldn't buy in the city where they live, so that they tried to invest somewhere else, and obviously negative gearing and stuff has assisted with that. So those things are now no longer available. So it's not just about first-time buyers getting into the market. That's super important, but it's not all about that. And it's not all about the rich 1% investor out there with a huge $1 million property portfolio. It's about people trying to create wealth. And I think you're going to see, a lot of people who maybe have a plan that's thrown into a bit of chaos. And plus with the interest rates increasing on existing mortgages, I did have a look at a $700,000 mortgage. What's a 0.25% increase? Now that's just one increase. There's already been a few, right? But it's one increase is about $32,000. So $32,000 is the cost of an increase to the individual, homeowner.
It's big.
Huge amount. And so so that's it's an interesting time. Awesome. Well, look, thanks for jumping on, Andrew. Thanks for as always. But we'll sign off and appreciate it. See you next time.
See you on the next one.